Strangle techniques to speculate in stock markets. Similar to a straddle, but the call and put have different strike prices. The strategy is profitable if the stock makes a large price move, but it typically has a lower upfront cost than a straddle. What is the primary objective of the strangle strategy in stock options trading? The primary objective of the strangle strategy in stock options trading is capitalizing on large market movements with lower costs compared to a straddle. This strategy involves buying an out-of-the-money, simply abbreviated as OTM call, and an OTM put option on the same underlying asset with the same expiration date, aiming to profit from significant movements in the stock price in either direction. The primary goal of a strangle strategy is to profit from large price movements in the stock, similar to a straddle, but with typically lower upfront costs. This is achieved by buying out-of-the-money call and put options with different strike prices. The strategy is primarily used for speculation, aiming at capital appreciation in scenarios where substantial market volatility is anticipated, but the direction of the movement is uncertain. How does the strangle strategy perform under different market conditions? The strangle strategy is ideal for highly volatile markets. It is most effective when the trader anticipates a significant price movement but is unsure of the direction. However, in markets with low volatility, where significant price swings are less likely, the strategy may result in the loss of the premiums paid for the options. Strangles are most effective in highly volatile markets where significant price movements are expected. This could be due to major corporate events, economic reports, or other market-moving news. The strategy is less suited to stable markets where large price swings are unlikely, as significant movement is needed to overcome the cost of both options. What risk is associated with the strangle strategy? The risk associated with the strangle strategy is limited to the premiums paid for the call and put options. While the strategy offers potentially high rewards, the trader risks losing the entire premium paid if the stock price does not move enough to make one of the options profitable. The risk in a strangle strategy is limited to the total premiums paid for both the call and put options. If the stock price does not move significantly, the trader may incur losses equal to these premiums. However, unlike a straddle, a strangle requires the stock to move more substantially to become profitable, given the out-of-the-money position of both options. What potential rewards can be expected from a strangle? The potential rewards from a strangle include significant gains if the stock experiences large price swings in either direction. The profit potential is theoretically unlimited on the call side and substantial on the put side, up to the point where the stock price drops to zero. The reward potential with a strangle is high if the stock experiences a large price move, either upwards or downwards. The best case scenario is a significant surge or drop in stock price, exceeding the strike prices of both options, which can lead to substantial profits. However, traders should have realistic expectations about the likelihood of such movements and consider the average expected returns. What are the key implementation steps for a strangle strategy in stock options trading? Key steps in implementing a strangle strategy include selecting suitable strike prices for both the call and put options, which is usually out of the money, otherwise known as OTM, choosing the right expiration dates, and timing the trade based on market volatility expectations. It's also important to monitor market movements and adjust the strategy as necessary to manage the positions effectively. Effective implementation of a strangle strategy includes identifying stocks or assets likely to experience significant volatility, buying an out-of-the-money call option and an out-of-the-money put option, both with the same expiration date but different strike prices. Choosing strike prices based on the expected level of price movement and market analysis. Monitoring market events and price movements closely, as timing can significantly impact the strategy's effectiveness. Being prepared to act promptly following substantial price movements to maximize potential gains. A strangle strategy in stock options trading is suited for traders who expect dramatic movements in the stock price but want to reduce the upfront costs associated with a straddle. It requires a keen understanding of market dynamics and the factors influencing volatility, offering the potential for high returns with controlled risk. Let's discuss the Iron Condor to speculate in stock markets. An advanced strategy involving 2 put options and 2 call options with different strike prices but the same expiration date. This strategy profits from low volatility in the underlying stock. What is the strategic goal of the Iron Condor strategy in stock options? The strategic goal of the Iron Condor strategy in stock options trading is profiting from low market volatility. This strategy involves simultaneously selling a put spread and a call spread on the same underlying asset with the same expiration date. It aims to capitalize on the lack of significant price movement in the underlying asset. The primary goal of the Iron Condor strategy is to profit from periods of low volatility in the underlying stock. This strategy involves setting up a position that earns income from option premiums and is successful when the stock price remains within a certain range. It combines the sale of both put and call option spreads, making it a popular choice for income generation rather than capital appreciation or speculation. How does the Iron Condor strategy adapt to changing market conditions? The Iron Condor strategy is best suited to stable, low volatility markets. It performs well when the underlying asset's price remains within a specific range, not exhibiting significant movement. However, in highly volatile markets, the strategy can be at risk as larger price swings increase the likelihood of reaching the strike prices of the sold options. Iron Condors are most effective in stable markets with low volatility. The ideal scenario is when the stock price fluctuates minimally and remains within a specific range. This strategy is less effective in highly volatile markets where significant price movements can breach the strike prices of the options, leading to potential losses. What is the risk profile for an Iron Condor strategy? The risk profile for an Iron Condor strategy is characterized by limited risk with a defined maximum loss. The maximum potential loss occurs if the underlying asset's price moves significantly beyond either the upper or lower strike prices of the spreads. This loss is limited to the difference between the strike prices of the spreads minus the premiums received. The risk in an Iron Condor strategy is limited and defined by the spread between the strike prices minus the net premium received. If the stock price moves outside the range of the strike prices at expiration, the maximum loss is realized. This loss is the difference between the strike prices of either the call or put spread minus the premiums received. What are the potential rewards of using an Iron Condor? The potential rewards of using an iron condor include income generation through the premiums received from selling the call and put spreads, with the gains being capped at the total premiums received. The maximum profit is achieved if the underlying asset's price stays between the strike prices of the sold options through expiration. The reward potential with an iron condor is capped at the net premium received from selling the option spreads. The best case scenario is the stock price remaining within the range of the strike prices, allowing all options to expire worthless and the trader to retain the full premium. However, the potential gain is limited to the premiums received, irrespective of how the market performs within the range. What are the considerations for implementing an iron condor strategy in stock options trading? Key considerations for implementing an iron condor strategy include choosing appropriate strike prices and expiration dates for both the call and put spreads, ensuring these strike prices form a range that the underlying asset is likely to remain within, and monitoring the market to manage the position as needed. The trader must also be prepared to take appropriate actions if the market starts moving towards either range's limits. To implement an iron condor strategy effectively, traders should identify a stock with low volatility and little expectation of significant price movement. Sell an out-of-the-money put spread, which entails selling a put and buying a put with a lower strike price and an out-of-the-money call spread. This means selling a call and buying a call with a higher strike price, both with the same expiration date. Choose strike prices that define the anticipated range of the stock price and consider the potential profit and loss scenarios. Calculate the net premium received, which is the income from selling the spreads, and understand the maximum potential loss. Monitor the stock price regularly to ensure it remains within the desired range, being prepared to make adjustments if market conditions change significantly. An iron condor strategy in stock options trading requires a precise understanding of market conditions and volatility. It is suited for traders seeking to generate income in stable markets, offering a balance between limited risk and capped potential gain. Careful selection of strike prices and diligent monitoring of the stock are crucial for the success of this strategy. Let's discuss the butterfly spread to speculate in stock markets. This involves using 4 options with 3 different strike prices. It can be constructed using either calls or puts and is designed to profit from a stock that stays within a narrow price range. What is the objective of using a butterfly spread in stock options trading? The objective of using a butterfly spread in stock options trading is profiting from minimal price movement in the underlying asset. This strategy involves combining both bull and bear spreads with the same expiration date, using either calls or puts, to capitalize on a stock that is expected to have little to no significant price change. The primary goal of a butterfly spread strategy is to profit from a stock that remains within a narrow price range. This strategy involves using 4 options, either all calls or all puts with 3 different strike prices. It's designed to provide maximum profit when the stock price is close to the middle strike price at expiration. The butterfly spread is typically used for income generation, taking advantage of the premium decay as the options approach expiration. How does the butterfly spread strategy fare across various market conditions? The butterfly spread strategy is ideal in low volatility, stable markets. It performs best when the underlying asset's price remains close to the middle strike price of the spread. In contrast, in highly volatile or significantly trending markets, the effectiveness of the butterfly spread decreases. Butterfly spreads are most effective in low volatility, stable market conditions where significant price movement is not expected. This strategy thrives when the stock price remains near the middle strike price, making it less suitable for volatile or strongly trending markets where the likelihood of the stock price moving out of the target range is higher. What risks are involved in a butterfly spread strategy? The risks involved in a butterfly spread strategy are limited and defined. The maximum loss is restricted to the net cost of entering the trade, which is the cost of buying the spreads. This limited risk makes the butterfly spread an attractive strategy for traders seeking to control potential losses. The risk in a butterfly spread is limited to the net premium paid to establish the spread. The maximum potential loss occurs if the stock price is at or beyond either the lowest or highest strike prices at expiration. The controlled risk profile makes it an attractive strategy for traders who wish to limit their downside exposure. What rewards can be expected from a butterfly spread? The rewards from a butterfly spread include capped gains within a specific price range. The maximum profit occurs if the underlying asset's price is exactly at the middle strike price at expiration. The profit potential is the difference between the strike prices minus the net cost of entering the trade. The reward potential with a butterfly spread is capped and achieved when the stock price is near the middle strike price at expiration. The maximum profit is the difference between the middle and lower or higher strike prices minus the net premium paid. Traders should understand that the gains are limited to this range and set realistic expectations based on this understanding. What key steps should be considered when implementing a butterfly spread in stock options? Key steps in implementing a butterfly spread include selecting the appropriate strike prices and expiration date for the options involved, ensuring the middle strike is aligned with the expected price of the underlying asset at expiration, and monitoring the market to manage the position effectively. The trader needs to carefully plan entry and exit strategies to maximize the potential of the trade. Implementing a butterfly spread strategy effectively involves selecting a stock with low volatility and a stable price outlook, choosing 3 strike prices where the middle strike is near the current stock price, simultaneously buying 1 in the money and 1 out of the money option, and selling 2 at the money options, all with the same expiration date, monitoring the stock price to ensure it remains close to the middle strike price, being prepared to close or adjust the position if the market conditions change or the stock moves out of the desired price range. A butterfly spread in stock options trading is a sophisticated strategy requiring an understanding of options pricing and market behavior. It offers a balance between limited risk and potential gain, making it an appealing choice for income-focused traders who anticipate minimal movement in the underlying stock.